At a high level, if you look at the portfolios, they've all been quite steady, quite solid this quarter. So they haven't changed in value much. The worst performing's down about 0.25% and the best performing up just a little under 1%. The better performing portfolios have been mainly in equities because bonds have been under pressure this quarter, and I will talk about that later on in the video about why that is and what that means. As fund managers, I'm glad to say that we have helped considerably this quarter. We've added about 0.5% to performance relative to our peers and the benchmark. And I'm delighted to say that we are ahead over 3 months, 1 year, 3 years and 5 years, quite considerably in every portfolio. So I think we are producing value for our clients, and it does talk to the consistency of the way we've been able to generate performance. So underneath within markets, despite the solidity of portfolios, there's been an almighty tug of war between the two camps of investors, those like us who think there's going to be a recession and those who think that actually we'll get through these issues and we'll recover smoothly. So 3 things have happened within markets that are very notable. Firstly, the dollar's been very strong. It's risen by 5% in the last 3 months versus sterling. Now, normally, a rising dollar is a sign of global financial stress as people scrabble to find dollars to meet liabilities in what is the global reserve currency. Oil going up is very dampening on economic growth, and oil was up by 20% in the quarter. And because oil is such an important feed into consumer prices, oil going up by that amount will dampen economic activity. But the most important thing that happened in markets in the last quarter was the change in the price of long-dated government debt. So the 30-year gilt, as an example, fell by 16% in the quarter. In just 3 months, it fell in price by 16%, and that is because the yield rose by 0.5%, which is a lot for such a major instrument as the 30-year UK gilt. Now, this is very important for financial conditions, but it's also really important for government finances. And in the next minute or two, I'm going to talk about why this is possibly the most important development in the last 3 months. Long-term government bond prices and bond yields are important for 2 reasons. When they rise, it's clearly a tightening of financial conditions. Just like overnight interest rates, like the government base rate rising tightens borrowing conditions. Actually, quite a lot of borrowing is done in the long term, so mortgages, corporate borrowing, and in particular government borrowing. So the higher yields are, the more borrowings cost, and that tightens financial conditions and depresses economic activity. But the last effect, the effect on government borrowing, is the most worrying here. Because the reason yields have gone up is because investors are concerned about the long-term outlook for government borrowing and the stability of government finances. So yields are going up to reflect the risk. Now, they've gone up to such an extent that it's already putting pressure on governments. And it has the potential to turn into a crisis. We don't predict that it will be a crisis. We think it's probably most likely not to be. But for the first time in 50 years, we're seeing this pressure from the bond market emerging on governments. To give you an idea about how bad it could get, if the US wanted to balance its budget in the long term, given the long-term commitments it's made to pensioners, welfare recipients, and of course to pay its own debt, it would have to reduce government spending by 7% of GDP or increase tax by 7% of GDP. And in the UK, we're not much better off, a little bit, but not much better off than that. If governments were to adjust in that way, we would have an enormous recession globally, bigger than anything in 2008, bigger than anything for the last 100 years. Now, we don't predict that will happen, but the rising bond yields introduce for the first time the potential that it might. Now, what this means for portfolios, it goes back to what I was talking about last month, about how you should build them. It's really important to keep the portfolio robust. So a robust portfolio is one that's able to cope with uncertainty and recover and keep you on track long term. So we can identify this concern, which is government finances, and it has the potential to become acute and turn into a crisis. We don't think so, but it could. Now, how we manage this is about how we structure the portfolio to avoid the worst of anything that could happen. So in the bond market, we have relatively low duration, which means our bonds have quite a short period to redemption, so they don't last that long. So the longer the bonds are out, the more they're exposed to changing interest rates and the more they go up and down. So our bonds are quite short term. We also sold out of all of our non-investment grade or junk bonds to reduce credit risk. So we're controlling risk in the bond market, and there will come a time, I hope, when we can increase risk again, but that's where we are today. And in the equity side of the portfolio, we're avoiding very expensive equities. So the US equity market being an example where we're very underweight. We don't have any growth specific funds, and we're exposed to cash generative, long-standing, stable, high-quality businesses globally, and we have quite a high commodities exposure. So this is how we round out the returns and make sure if the worst happens that we perform relatively very well, and therefore we're in a position like last person standing to take advantage of the weakness that has arrived. Our portfolios have been very solid this quarter. But really what's important is what's going to happen next. And I think we're well prepared for that. So we have a robust portfolio, and I think we're positioned to do much better than our peers in the next year or two. As always, if you have any questions about this, please get in contact with me directly. I must remind you, I've been talking about investing, so your capital is at risk. And if you like the video and you'd like to be automatically subscribed, please click on the flying colours icon.